Welcome everyone. I am Sonali Seth Chawla, Assistant Professor, Management Department from Sant College of Higher Education. I am going to explain the subject business environment. It is the subject for BBA first year and the subject code is BBA-112. The topic for this business environment is fiscal policy. Now, I will discuss fiscal policy. In this matter, I will discuss introduction and meaning of fiscal policy, objectives of fiscal policy, and instruments of fiscal policy. Now, introduction to fiscal policy. Fiscal policy is a part of macroeconomics. This policy is also known as budgetary policy. One major function of the government is to stabilize the economy. Current Indian government wants to achieve fiscal deficit target by not reducing expenditure by increasing tax collection. In Keynesian economics, when the government changes the level of taxation, the government spending, it influences aggregate demand and the level of economic activity. What is exactly the fiscal policy is? The word fisc means state treasury and fiscal policy refers to the policy concerning the use of state treasury or the government finances to achieve the macroeconomic goals. Further, fiscal policy involves the decision that a government makes regarding collection of revenue through taxation and about spending that revenue. It is also known as a sister strategy to monetary policy through which central bank influences a nation money supply. Now, the objectives of fiscal policy. The few objectives are development by effective mobilization of resources, reduction in inequalities of income and wealth, price stability and control of inflation, employment generation, reducing the deficit in the balance of payment, increasing national income, development of infrastructure. Now, I will discuss instruments of fiscal policy. These are budget, taxation, public expenditure, and public debt. First instrument for fiscal policy is budget. Budget is the major aspect and instrument of fiscal policy. A budget is a detailed plan of operations for some specific future period. Budget is presented by the Finance Minister of India. Budget is also known as Annual Financial Statement of the Year. Next instrument for fiscal policy is the taxation system of the country. In India, we have two types of taxes levied by the government. These are direct taxes and indirect taxes. Indirect taxes are levied on goods and services, where direct taxes are levied on the income and profit of the individuals, organizations and firms. Direct taxes in the form of income tax and indirect taxes in the form of taxation collected from the customer like GST. Next, most important instrument of fiscal policy is public expenditure. Public expenditure is the spending made by the government for the country's collective needs and development. Public expenditure is a major important component of aggregate demand. It includes revenue expenditure and capital expenditure. The next instrument of fiscal policy is public debts. Public debts are the major instrument for fiscal policy. Public debts is defined as any money owned by a government agency. These are of two types: internal borrowings and external borrowings. Internal borrowings means the borrowing from the public means of treasury bills and government bonds. Next is borrowings from the central bank, that is in India from RBI. External borrowings. External borrowings means when government is borrowing from the external international resources, that is foreign investment, from the international organizations like World Bank and IMF, and market borrowings. That's all in this matter of fiscal policy part 1. I hope everyone will understand and appreciate the matter. Thank you.